Natrajan, Managing Director with DCB Bank. Murali, good morning. Thank you for joining us. Let's understand the big picture for us. The big picture for the quarter gone by. Has demand, has credit offtake, has everything finally come back into place? Has the coin fallen in the slot, like they say?
The bank is focused on MSME sector for the last many years. Can you hear me? Am I audible?
Yes, sir. Good morning.
Yeah, good morning.
Yeah.
So, would you like me to respond?
Yes, please. I just wanted to start with the introductory question and perhaps an answer on that, summarizing the big picture, because the quarter gone by was in a sense full of twists and turns and peak and turns given the macro conditions.
Yeah. So that is what I was responding to. That, as you know, for the last many years, we have been focusing on MSME sector. And what we find is that the demand is coming up and back again pretty much close to the pre-COVID levels. We are increasing our footprint, we are increasing our distribution, we are increasing our employees. The upgrades, see, when you look at recoveries and upgrades, our upgrades are 76% of the total recoveries and upgrades, which shows that the cash flows are coming back, and therefore, I would put it as saying that we pretty much are seeing improvements all around. So we are very positive about the coming months and year.
The other factor which I want to discuss with you is what is happening on the CASA front. The industry trend seems to be that CASA is migrating towards large bank, and mid-tier banks in a sense are struggling. As a result, they are giving higher deposits, which could come at the cost of ROA and spreads.
Our CASA ratio has gone up to 28%, and we are targeting a higher ratio than 30% in the coming months based on two or three things. Number one is that we are offering a very tiered pricing on the SA, and which many of the larger banks are not offering. But what essentially happens is that customers build their balances over time, and as compared to a term deposit, you get an advantage in the cost of funds on the SA. Plus, the cross-sell opportunities are also much higher on SA. If you look at our SA, as compared to last year, we have grown by more than 60%, and our CASA itself has grown by more than 50%. We believe that the amount of effort that we are putting on digital, making it easier for the customer, the product, the distribution, the scorecard that we have put on the branches, we don't see too much of a challenge in growing our CASA in the coming months.
Seeing much challenge on CASA going forward. When we, of course, look at the performance and what has been declared, I want to talk to you a bit about that. Good performance, but going forward. Now, you have several small finance banks that are offering what? A 6% plus on savings. Many are now going to be able to also improve thanks to tech. You're also going to be investing more, you're saying, on your frontline branches as well. What will be the differentiator going forward?
I think the differentiator is two things. First of all, customers are now getting used to a tiered pricing in SA, which was started many years ago by different banks. That is number one. Number two, they want ease of operations, and that is a continuous process. You have to keep investing in technology. You have to keep making the life easier for the customers so that they can do more transactions much more easily and faster. That is two. Third is the cross-sell that we do to these customers is also a very important aspect of that, because they find value in those cross-sell. So if you are able to do that consistently and make sure that your scorecard for the branches are aligned to that, then it seems like it works very well in terms of growing CASA. Competition is something that we are used to. We have been facing competition for the last so many years, and yet we have been able to grow our balance sheet and our size. So that is part of how you need to manage your business.
While declaring the result, where we've of course seen net profit rising 188% year on year, the statement says the monthly NPA slippages, excluding gold loans, are steadily moving towards pre-COVID-19 levels. So just taking off from that as well, recoveries, how do they stand? Is there any stress also that you see when it comes to CVs being a drag?
You mean commercial vehicle?
Yeah.
You mean commercial vehicle? Yeah, so let me explain our NPAs. First of all, for the past 3-4 quarters, you can see that our upgrades, recoveries have been pretty much keeping pace with the slippages. And I would like to break down the slippages into two parts: gold loans and others. Others are mainly contributed by mortgage and commercial vehicle. Mortgage, commercial vehicle slippages are almost at pre-COVID levels. Say if you compare with the third quarter of 2019-20, maybe in another 1 or 2 quarters it will move towards that direction, and this includes any slippages that we may have had from our restructured book. Gold loan is a very peculiar situation. We offer OD product in gold loan because we want to make the customer have the habit of servicing their interest on a monthly basis. Now, what has happened is that there is a change in norms that happened on November 12, 2021 by the regulator, and customers are not used to that change. So we are educating the customers. In the change, what has to happen is every day the previous 90 days interest has to be serviced in effect. So customers are having cash flows. You know how self-employed is. They may have some erratic cash flows, so they are thinking that if there is a delay, it is all right. But the delay makes it an NPA. That is why we are spending a lot of time educating the customer in gold loans. The underlying security is very good, and therefore we are unlikely to have any credit loss on that account. Overall, NPAs are moving towards pre-COVID levels, and we expect the recoveries and upgrades to be strong, at least for the next 2 to 3 quarters. Therefore, we think that our provision that we will make this year is likely to be much lower than last year.
Okay, so let's see how that one progresses as well. Thank you so much for joining us live today to take us through the earnings fine print and, of course, the road ahead. We're going to